Today I'll talk about a plan we put together for a couple nearing retirement that allows them to retire within the next 2 to 5 years. This is actually one of my favorite things to do when it comes to helping someone map out their different retirement strategies. What we typically do is look at where someone is right now, what does life look like if they just keep doing what they're doing, and then what are some alternatives that we can provide with different life insurance products, annuity products, different options that exist. Why I like doing this is because when it comes to insurance, I do know it kind of well just from doing it for a very, very long time. So we can leverage different products and strategies that are available that help people retire when they want to retire, with the amount of money they want to retire with, and not have any stress. Because the nice thing about insurance products is typically you have guarantees associated with it, so you know what you're going to have when it comes to retirement. So what we've got in this case, our married couple, we've got Dan and Debbie. Dan's 54, Debbie is 61. She actually just turned 62. And their situation is that they just went through a rough exit at a company that Dan was actually a partner at. And the situation does not look good. He was owed a ton of money and he might end up with nothing. So it was very taxing on them, both financially and emotionally. He got a new job that he does enjoy. However, at this point in time, he's just tired and he's expressed multiple times that he wants to be able to retire ASAP. So we're going to show him how he can potentially retire ASAP. Now, in a situation like this, there are a lot of conversations that occur really so I can understand the individual's goals, or in this case, the couple's goals. So where they're currently at, they earn a healthy income. They earn about $350,000 per year. They also earn bonuses between $100,000 and $150,000 per year. So their income is up there, which helps him a lot because he does want to retire ASAP. Now, they are also extremely organized and they have their expenses mapped out that range between $150,000 and $200,000 per year. So in preparing for retirement, they know what they're going to have in terms of some reliable sources. They've got Social Security at age 62. Dan will receive about $33,000 per year, and Debbie will receive $12,400 per year at age 62, which he actually just started this. So if we look at the combined amount, it's about $45,000 annually. Now, they know real estate inside and out. The company that Dan works for now is a real estate company. The company that he worked at previously was a very large property management company. He knows real estate, he knows the game, he's done it forever, and they've got some rental properties that they personally own. And the income that they'll have will be somewhere between $98,000 and $124,000 per year. So that's going to put their total income when they retire somewhere between $143,000 and about $168,000. Here's the problem and what they expressed. Their target income during retirement is $200,000, and actually a little bit higher than that. The reason why is because since we started working together, this thing called inflation just seems to continue and things get more and more expensive. And the feeling that $200,000 is going to do it for them forever, probably not going to be the case. Now, in addition to just wanting the income, they also want to be able to leave money to their kids. Now, they've been doing a lot of research on different retirement strategies, different areas to put their money. Real estate is his thing. He knows that works, but he's also interested in cash value life insurance because he understands how he can leverage the product. And he's also very interested in potentially taking income from the product on a tax-free basis, which we'll look at in addition to some other strategies. So the life insurance he's interested in, and the reason why is because it's extremely liquid. Before and during retirement, he can access that money tax-free, and if he wants to use it to acquire another rental property, which will produce income, he has the ability to do that. It is extremely liquid. This is why he expressed, I definitely want this. What I can also do is produce income, where I just take withdrawals and loans, And if you play it right with a life insurance policy, all of the income can be tax-free. We're going to look at models that demonstrate exactly this. The thing is, we also looked at an annuity. An annuity provides a guaranteed income stream. However, the gains are taxable. And if the annuity is funded with an old IRA or 401k, a qualified account that has grown tax deferred, everything is going to be taxable to you as income. In their particular case, they don't have too much money in IRA funds. So if they fund an annuity with non-qualified money, which would be cash, the gains would be taxable. Also, with an annuity, what he did not like was the fact that it is not that liquid before retirement. I'm basically buying future income with this product. Back to the life insurance, while the income can be tax-free, when you look at the actual income it can produce, it is less than an annuity. And the reason why is because an annuity doesn't carry a life insurance expense as well. There's no cost of life insurance with an annuity. It's just a product where I am guaranteed an income stream. So I can get more bang for my buck from an income standpoint with an annuity, but the life insurance does give me life insurance, gives me more liquidity, it's got a nice tax benefit, and then when I take that income, it is all tax-free. So there's pros and cons to both. So we're going to look at different strategies that involve both. And what I want to start with here is as we look at all of these plans, we're going to walk through what his life looks like now, before retirement, and then also what it looks like after retirement. We're going to lay out all of the income sources. But with all of the plans, where he is right now, while he is still working, is he and his wife know that they can fund $200,000 per year. They mentioned that in their first email to me before we even spoke. And that's based on their income and the expenses, their taxes, everything. They're like, we know we can do this. So being that I want to retire ASAP, can I hyperfund a policy or any type of plan that doesn't take on any market risk and be able to hit my $200,000 per year in income? That's what we're going to look at right now. We'll start with option one, which entails working for 5 more years. And this strategy only involves cash value life insurance. The rental income he'll have in this particular scenario will be $124,000. Let's take a look, shall we? Option one, Dan works for 5 more years. So what you'll see first is his W-2 income at $350. With bonuses, that's probably going to be closer to $500, but we're not going to include that in this chart. That's his W-2 income. Okay. Next, we've got Social Security. So when we look at this, we see Dan's in light green and his wife's, Debbie, in dark green. Hers actually started already. We've got here 2026, but it technically started already at $12K per year. And we see that his will start down here. This is actually when he is 62 years old. It'll be about $33,100 per year. Okay, so we see what Social Security will be, but notice his doesn't start until a ways down the road, well beyond 5 years. Then we've got the rental income. So they have a clubhouse that actually used to be their primary residence. This is out of state, so they moved to a different state. They still have this, and they're thinking about renting it. They also know that they can easily sell it. Based on the location and state that it's in, it'll sell very, very easily. But we're going to look at a scenario that involves keeping it, and he knows that it can produce $26,000 per year net after taxes, expenses, everything, at least $26K per year, probably more, but that's the number he wanted to use. So that property is $26K. He's got another rental with $24,000, a third rental with another $24,000, a fourth with another $24,000. These are each producing a net income of $2,000 per month. And then also, when they retire, they plan on traveling, and he knows he can rent out their current residence for at least $26,000 per year. Again, these are net numbers. So the different income sources, we see what's being produced now and also when Social Security begins. And then we're also going to factor in the whole life insurance policy. So there's a lot here, What we'll do in a case like this is tally up the income. So we've got total income. During my working years, the income is quite high. And this is without his bonuses, which kind of tells you why he said, as long as I'm still working, I can fund a policy with $200K per year. His income is extremely healthy and they are saving a lot more than what they're spending. But the goal when he retires was what? $200,000 per year. So what we did in this scenario in 2030, which is after 5 years has passed, the total income you see here is $200,000 per year. Notice the whole life insurance policy. I'm going to show you the actual illustration in a moment. For 3 years, we're taking $63,500, and then we kick that down to $30,000 per year. Let me show you that actually. Here you go. So here's the life insurance policy, funded with $200K per year. Here's your cash value buildup. By the 5th year, you've got more than $1 million in cash value. Then years 6, 7, and 8, you are taking $63,500. That's an income coming from the product, and then it drops to $30,000 and change. Why? Why would we do that? His Social Security. When that kicks in, we don't need to take as much from the life insurance policy. So we kick the income down there. We could keep pulling more. What you'll notice here is income is coming from the policy. And how's it impacting his cash value when you look at the policy here? His cash value is still increasing every year. Dividends and interest being produced are well in excess of $30,000. So this does give me some peace of mind when we look at the strategy, because if he needs to pull more because he wants more or because of inflation, he can easily do that. I'm looking at this and saying, okay, like he can easily pull another $10,000, even $15,000, even if the dividend goes down because it's growing by more than $20K per year. So we've got some window room there, which is really nice. So this strategy, which is all life insurance, works quite nicely. The thing to mention is that it involves him working for 5 more years, and the total input to this policy is $1 million. So what I like to do when we look at these strategies is ask, what are your thoughts? The numbers, the time, everything. The time period, he didn't like. 5 years is definitely the long end of how long he still wants to work. He's like, I don't want to go that long. I'm like, okay, let's see if we can make it work without working for 5 years. What if we work just for 3 years? What would that look like? So what we'll look at here is aggressively funding a life insurance policy. What we're also going to do is sell that property in the state they used to live, and the sale price will be at least $750,000. And then we're going to fund a policy in addition to the $200K. We're actually going to fund it with $225,000 out of pocket and the $750,000 on top of it to see if we can aggressively fund that policy so it can then produce enough income after he works for only 3 years. And the rental income here will be $98,000 because we're taking one of the properties away. In fact, let's take a look at the model. So option 2, here we go. Working for 3 years, not 5 years. So there's that W-2 income. There's the Social Security. Here's your rental income. What's different about this one? No income from the clubhouse because we're assuming this is sold. The sale price will be at least $750,000. So the whole life insurance policy, we're going to have to pull more income from this because we don't have income coming from the rental property. Here we go. So total income. When he retires, which is after 3 years in this example, so this is the key, in 2028, the target income is $200,000. Can we attain that? Yes, but there's two issues with this. One, eventually we run out of money, and that's when he's 90 years old. Some people I talk to say, I'll be dead. I'm like, okay. Yes, that might happen, but what if it doesn't and you run out of money here? Now you got to adjust your lifestyle. It's not good. The other thing is, he does have longevity in his family. His parents have lived for a long time, so there is a good chance that he will as well. But the other problem with this is why that income drops at his age of 90 is because pulling this amount of income from the policy, so here's the funding. We funded at $475 per year. So let me just hit on this point quick. He funds from his cash flow to $25 per year. And then you also have the real estate sale, which was $750, divided over 3 years is $250 per year. Add those two together, that's how you come up with the $475 that we see going in here. And this proposal was actually his idea. He said, hey, what if we do this and just stuff this policy for a few years? I really want to see what this looks like. Like, all right, you can. I don't think it's going to work from an income standpoint, but if I'm him and I ask that, I wouldn't want someone just to tell me no. I'd want them to show me the numbers. Therefore, we showed him the numbers. Here's the unseen element about this, the second item I want to mention. When we stretch a policy like this, so we take income out and eventually we run out down here. What we don't see on the spreadsheet, but we would see on the illustration, is the policy calling for more money. And if we don't pay it, it would lapse. If a policy lapses, where I have pulled out more income than what I've paid in, and I have unpaid loan interest because I haven't been paying the interest as I've been taking tax-free income, that'll trigger a massive tax bill that no one wants. This happens on occasion. A lot of times we see it or hear about it with universal life insurance products, not so much with whole life, but it can happen. The other thing is, if dividend rates go down at all over the next 30, 35 years, that'll result in this happening sooner. Like, what if it happens around his age of 85 or 82, when chances are very high that he'll be alive? That's where it becomes a problem if we run out of money here. So my advice on this option, option 2, was not to go this aggressive in trying to fund a policy in this short period of time. It would be better to go with option 1, where you keep the rental property, fund a policy over a 5-year span, and then we know we can easily take the income out that we know. This is too aggressive in terms of trying to make this work. And I could use different companies and products that might make this work, but it's probably going to happen. And then that turns into a real problem for him down the road. So option 2, I would not recommend. But that doesn't mean he has to work for 5 years, because that defeats the purpose. So, option 3, a different strategy where we work for 3 years. Want to see it? So this one involves life insurance and an annuity. We're going to do the same thing where we sell the property for $750. We're going to use that $750 to fund a plan, which if we sell that property, our rental income then goes down to $98,000. Let's take a look here. Here's your income for 3 years. There's the Social Security. Clubhouse, sold. Therefore, no income. Check this out. What do we got going on here? Income is coming from an annuity. Nothing from the whole life insurance policy. Look at your total income. So Debbie gets a $750,000 annuity. Why would we put it on Debbie instead of Dan? Because Debbie is 61 turning 62. Dan is 54. If we put the annuity on him and he starts to distribute income before his age of 59 and a half, that could trigger a 10% penalty tax. So we don't want to do that. That's why we looked at it on Debbie instead. So how this works is I get the $750,000 annuity today. I write a check and fund the annuity, and then I don't do anything with that money for the next 3 years, which I didn't like that much. But it's an option we still showed. I really liked this couple a lot because for the things that they didn't like, they still said, still show us the different options. Throw your ideas at us so we can see it. And then what I did was, to the best of my ability, presented it in a manner where hopefully they understood it, which is similar to what we're doing here, just going through one line item at a time. But they still wanted to see the different options so they could understand what people are doing in different situations. So here, retires in 3 years. The income initially is 178, and it stays at 178 until Dan's Social Security kicks in. Then it's $211,000 and change. And when we went through this piece here, they were okay with it because they did say if the income is actually between 175 and 200K, that's really what we think we can make work or make ourselves more than comfortable during retirement. But the target is 200. So this gets them very close, and they could actually supplement their income quite easily with the whole life insurance policy, which we're not showing here, but they can easily do it. So what we did here is during his working years, we funded a policy with 200K per year for 3 years. The annuity, which came from the property sale, was funded up front with the 750. All right, see what's going on here? Funded the policy with a total of 600,000. If I want to take 22,000 out per year here, I could do that quite easily to supplement my income. In this case, we didn't model that because the income was close enough where they said, hey, that's good. So what this does for them then is they've got the income they want, especially when his Social Security kicks in. Here's what I really like. They've got this cash value sitting on the back burner that they can access tax-free. There's a big liquid pile of money that I can get to. I've got the tax benefit, and if I want to turn on an income stream, similar to what I saw in the other examples, I can do that too. So I've got a backup asset here, and also they've got some other assets as well. These are just really the main pieces we're using when we put everything together to look at their overall plan. Now, the thing that I like about this is option 3. When Dan is getting older, let's say at 90, his death benefit is close to $3 million. So this gave him the income he wanted and gave him a cash backup and left a lot of money income tax-free. And a conversation we had regarding the rental properties was the kids potentially taking these over, and both Dan and Debbie go, no, probably not. They got their own things that they're doing. It's going to be difficult for them to manage those properties. Not to say it's not possible. A lot of times things change, but being able to leave a big life insurance policy, income tax-free, to the kids instead gives a lot more leverage, especially if they want to sell the properties. If they've got this money sitting there income tax-free, they're not going to be in a rush to sell those properties because they've got money where they can go out and find the right help or perhaps hire property managers. That money gives them a lot of flexibility there. So option C, I liked a lot. The problem with it for Dan was tying up the $750,000 where he's always been a real estate guy. So he said, I just have a hard time doing that, tying some of the money up or all of it where I could just use it to continue to purchase more real estate to create my own income if I want. But that's where we talk through these. And then option 4, which is a very similar strategy, except we're only going to work for 2 years. So here I might say, well, with the annuity option, would you be comfortable with that if it was only tied up, call it for 2 years, and it could help you retire earlier? Let's take a look. This is the last option for today's video. I hope you are enjoying this. I'm having a blast with it. All right, so here's our income. Working for 2 years, there's your Social Security, there is your real estate income, all that good stuff, and here we go. So with the annuity, what do we got going on here? We're starting the annuity payment when? After 2 years. And again, we're doing this for Debbie. That'll guarantee $65,000 per year. By the way, the annuity, you can set it up where you don't have to pick it up front to say income's going to start in 2 years, 3 years. No, you know exactly what the income will be, but you can flip that switch on when you want to flip it on. So if they plan to retire in 2 years, but it ends up being 3 or 4, and they defer with that annuity, the income payment will be higher, which is nice. So with this strategy, what we looked at was funding the policy with less, $150,000 per year, to keep more money liquid if I want to use it for something else. After the 3rd year, I paid nothing in. Cash value continues to grow along with the death benefit. Now, when I look at this guy, by 90, death benefit left is about $2.2 million. Option C left a lot more. However, he also worked for an additional year, where here he's only working 2 years, which means I funded the policy for a shorter period of time. See what's going on here? Anyway, different options here. Now, I liked option 3 because it provided the income and had that nice cash backup. But after discussing all of this, he actually went with a different option, which involved just cash value life insurance, where he funded it a bit more aggressively because he does have the means, factoring in some bonuses that are coming, and the overall plan will work beautifully. We will share that particular strategy in a future video. I'd love to hear your thoughts on the 4 strategies we went over here though, and which one you like the most. Thanks so much for watching all the way through, and as always, I hope this helps.